Welcome guys, this is a quick update video. Um, I'm Jay, by the way. So the lending business model I've had tons of interest in over the years. It's been really good. It's helped a lot of people, and I've had three separate people request the same exact upgrade to this specific uh, template. So what I've done is I've included a general version of the update. Uh, and so the first thing, there's two things actually. The first thing is you can now use a rolling credit facility. What that means is this row 29, you can now select if you want to fund lending activities with a credit facility. And if so, you can define the percentage. It could be 0%, 100%. So watch this. If we go over to the monthly detail down here, you can see now lending activities. Now this is just for lending activities specifically, not for all the other general operations. So that means essentially the net effect of loan disbursements, collections of principal, origination fees, and interest fees, and defaults. So the net effect of all that is subject to being able to qualify as something that you can borrow from a credit facility. And so the amount that you can borrow goes here. The actual borrowed amount is here based on that 80%. So you can see this 1.1 million. I could put this at say 50%, and then you can see everything changes. Now it's at credit facility proceeds is about half of this exactly, which should be, that's right. You can find the interest rate right here on the monthly detail tab, and that's it. And then you've got interest, and basically you make a margin between the interest you're paying on the credit facility and the interest you're collecting from borrowers on these different loan types. So that's the first update, and that's just a general update. You could choose yes, no. If you hit no, you can see this goes away. Uh, you don't pay, you don't have any credit facility proceeds at all, and you're not paying any interest on that either. Um, where was I? Oh, the other update I did is let's set this back to yes. Um, oh, you can also choose to repay the facility upon exit or not with this yes no selector. Usually, if you're going to have some kind of an exit valuation, then you're going to always have this as yes, but I gave the option to possibly not if you're just going to run it into the uh, end of the forecast. Okay. The other update is you can see on the distribution, before it was a little bit more complex. Now it's more simple where you have any negative cash flows going out here, any positive cash flows per month going up here, and we're doing the IRR calculation based on the ongoing requirement rather than finding the minimum cash position and getting that all up front. The reason why for this specific one is if you're doing growth here, you're probably going to be cash negative for quite some time. So not just like a year or two, like with a normal financial model that I build, I'll usually just roll all the cash requirements up into the year zero because it's often only the first year or just the startup costs that need funding, and then the model will get to profitability. It still did show in the other template I do, it'll show the negative cash requirement each year, but it just rolls up the IRR calc to have it all at the beginning. This change now smooths it out as it actually is needed and does the IRR calc based on that for the project as well as for investors and owners, and they can see their individual cash requirements by year. You can also see on the balance sheet by month, you can see the amounts coming from investors versus remaining equity over time. And that's just based on the investor proceeds here and the percentage they're investing versus the owner's investment amount, which you can update this, and then the owner equity will automatically change according to the minimum equity requirement of the entire deal. So this shows the total that will happen over time, but the actual IRR calcs are based on the calculation that amount getting dispersed or collected from owners investors over time. So that's that other change. Both things I think are really good to help make this template more usable. You can see on the cash flow statement as well. Um, you've got equity contributions received here, and you can see it's a number that changes over time rather than right up front, and it's dynamic. So that's it. Otherwise, the template, all original base logic is still the same. You can scale out loans, any number of loans per month here. Really awesome logic. This was very hard to build dynamically, but it works. It's been super useful to a lot of people. Um, and yeah, I guess that's about it. Anything else I could think of? No, I think that's it. So enjoy. I like doing these small video updates. This is an update that didn't warrant an entirely new um, overview video for the template, but I did want to do an update saying that these were added, and I've made notes on the product page about it, or on the template page. So, oh yeah. And if you want to check out more, go to smarthelping.com. This model I just upgraded as part of the lending bundle, which you can buy for $149, or you can buy individually for $45 here. And you can see I've got the updates noted here that I just talked about. And you can check out more. I've got all kinds of different models. You can actually buy everything I've ever built for $9.99. I've got many unique financial models that are just as high caliber as the one I have just upgraded for all different industries and uses here. Real estate, SaaS, industry specific, joint venture waterfalls, accounting tools, HR tools, personal finance, some really cool stuff in Google Sheets tracking, sales pipeline management or lead tracking, and valuation. All right, well, that's all I got for you. I'm probably going to be streaming here in about 2.5 hours to finish the upgrade to the vending machine three-statement model integration. So have a good one, and I'll see you on the next one.